You will have noticed over the last year that this cycle is really different than a normal economic cycle. And one of the things that makes it different is that in spite of a lot of the commentary, this is a very low inflation cycle. And again, in spite of a lot of commentary, when I look at all the best stuff that's coming out of central banks, either by the Federal Reserve or the RBA, there is very little chance of a major breakout of inflation in this cycle, certainly before 2025. So what drives the policy instruments that drive the economic cycle at very, very low levels of inflation are not movements in interest rates, because there's no point to move around interest rates if there's no inflation. The policy instruments that drive the cycle are budget stimulus, the expansion of budget stimulus, and the contraction of budget stimulus. So what does the budget outlook in the US tell us about the US economic cycle? Well, as I've been saying since July last year, you've got an enormous expansion of the budget deficit, 14.7% of GDP last year. Because growth is so strong this year, that the deficit, which is in nominal terms bigger, that is to say in dollar terms bigger this year, is slightly lower relative to GDP. It falls down to about 13.9% of GDP. But then that stimulus falls away dramatically over following years. And what accelerates that decline is not the increase in interest rates, but an increase in taxes. So it is taxes that is the wall that this expansion is going to run into, and it is taxes that is the wall that the stock market is going to run into, not an increase in interest rates. And we can see this wall emerging in the form of the increase in taxes, that particularly taxes on corporations, that Biden is incorporating into his infrastructure package. Now, is it important for those tax increases to happen at all? It's really interesting that if I look at the decidedly left-wing Paul Krugman writing in the New York Times, what he says is that in a piece called Bidenomics is as American as apple pie, he says, actually, given the extremely low borrowing costs, it is not obvious that we would even need a tax hike if infrastructure spending were the end of the story. But we will need more revenue to pay for the whole Biden program, which everyone expects will eventually include another round of spending targeted on families and family welfare. So the reason we need the tax increases is not for infrastructure, which we could pay for just by, the US could pay for just by issuing debt. It's still a very low level of 1.7% for a 10-year bond. It's really because what the Democrats are doing is creating an American welfare state, and you need revenue for that. Now, I've talked about before how when Europeans started this after World War II, they started with big taxes on business, but they gave up after a while. It took them about 20 years to give up, and they substituted instead raising money from value-added tax. The Americans have yet to discover that. Give them 10 years or so, they'll get to that point. But we do have significant tax increases, and we do have significant tax increases on business. In an article in the the Wall Street Journal called "Here Come the Biden Taxes," it notes Mr. Biden's corporate tax increases alone are more than $1.5 trillion US over 10 years, with another 1.5 trillion coming soon in individual income and investment tax increases. Now that's about $300 billion a year, or 1.36% of GDP, says the Wall Street Journal, assuming a US GDP of $22 trillion. And it then talks about research, which says that this is 1.3% increase in, this is 1.3% tax increase of GDP, which makes it the biggest tax increase since 1968. They go on in this article, which I think is wonderfully written. The great political fakery here is that corporate taxes fall merely on CEOs and rich shareholders. As everyone knows, corporations don't really pay taxes. They are vehicles for collecting taxes, and those taxes are ultimately paid by a combination of customers in higher prices, workers in lower wages, and shareholders in lower returns on investment. The economic literature is clear on this point, and they talk about Kevin Hassett, who I've talked about before, and other economists who have done expensive work showing how lower corporate taxes result in higher wages, and therefore higher corporate taxes result in lower wages. Higher after-tax profits mean more corporate investment, therefore lower after-tax profits mean lower corporate investment, which means less productive workers whom companies can afford to pay less. In other words, they say the Biden's middle-class corporate tax increases will hit the middle class hard in both in their wages and in terms of their investment. And they also note in a separate analysis by the Penn-Wharton budget model that this will reduce growth by 0.9% by 2031. I think it's worse than that. I think what actually happens is, as I've said before, that when you move money from, you increase corporate taxes and use that money to finance consumption, what you're doing is you're taking money away from the most powerful part of the economy, which is, to say, private investment, and you're giving it to one of the slowest contribution to the rest of the economy areas, which is consumption. And in talking about that before, I've said that if you spend an extra dollar on investment, then you add about $4.50 to the economy over 5 years. So if you spend an extra dollar on consumption, then you add about $1.40 to the economy over 5 years. So every dollar that you take away from investment and give it to consumption is costing the economy $3 worth off for each one of those dollars. So I think this increase in corporate taxes reduces the structural growth of the US economy, and I think it reduces the structural growth by about 0.75% per year after a 5-year period, and it's ongoing from then. So apart from the effect that obviously an increase in corporate taxes is going to knock down stock market profits and affect the US stock market next year and the year after when it takes effect, not this year, next year and the year after, it has a slowing growth on the US economy, a slowing growth on wages growth, and structurally weakens the US economy in the long term. This is what the Europeans discovered after 20 years of doing this after World War II. I imagine the Americans will discover this too if they continue this policy for long enough.